Chris, you and your partner Ron Basu, you manage $3.5 billion for high net worth individuals, institutions. You're going to be talking to your clients this week and early after the new year and telling them to reflect on what's been a very difficult year, even for long-term investors. What are you going to tell them?
Well, no doubt. If you look at this year, we had 2 referendums, UK, Italy, which basically threw out 2 heads of state. We've had about 40 different elections. We had a huge election here in the United States, all sorts of concern and pressure on the market. And yet, we're basically where strategists thought we would be at the end of the year. We're up about 10%. So I think if you really want to understand what happened in 2016, we need to look back to 2015. And the 2 things that really drove performance in 2015 were oil prices and China. If you look at oil prices, we had a supply side correction. We had a lot of production, primarily driven by OPEC and Saudi not cutting. And we saw a situation where oil prices dropped below $30. We also saw China basically initiate a hard landing. They cut back on corruption. They cut back on lending. They let their currency devalue. And that basically created an industrial recession. That recession went through 2016 and into the first part of 2015, which created a lot of the angst besides the stuff that we talked about before. Subsequent to that, we started to get what we think is a real global recovery. And so the things that did poorly in 2015 really did well in 2016. So industrials, energy companies, material companies, all of those companies that were down in 2015 really did well in 2016.
But wasn't that just a reflection of the fact that Donald Trump won and nobody actually thought he was going to win on Wall Street? And so all of a sudden they found their portfolios stocked with things like tech companies, and they were long tech and they were short financials. And so they woke up and said, oh my goodness, we need to reverse all of this. So suddenly they went out, they bought industrials, and they sold tech, and they bought financials. I mean, we are living, as much as, if you compare it to 2015 and China and oil, et cetera, we are living in a different world because we are going to see different economic policy.
Well, no question. I think if you look at performance within sectors, right, most of the performance that we're talking about, these all-time highs, was driven up into the election. And there was a lot of pressure weighing on the underlying investor going into the election. So if you remember, 2 to 3 weeks going into the election, we actually saw the markets start to sell off again. When we got that certainty with regards to who was going to be the next president of the United States, what those policies were, we immediately got a push up in the markets. Mm-hmm. And what we really think happened is that the Donald Trump election, focusing in on tax reform, focusing in on infrastructure spending, focusing in on deregulation, basically turbocharge this recovery.
Chris,
okay.
A lot of people in the beginning of this year were incredibly scared to touch energy, to touch high-yield bonds, to touch commodities.
Right.
You put your clients in these assets. So I want to know, what are you doing now in a similar way to what you did in the beginning of 2016 for 2017? Because that's really the key in terms of trying to now invest for the long term into this new paradigm.
Absolutely. No, I think you hit the nail on the head. I think in order really to be a long-term investor, you really have to be patient. And you have to have really a strong stomach to go through these periods.
Where do you want to be right now? Where is everybody else looking away that you want to start to invest?
Well, no, I think we're overweight equities versus credit. So, and within equities, I think you want to look at 2 particular areas in particular. I think this secular growth story with regards to industrials, energies, material, financials will continue to ride out. I think you also want to start looking at growth at a reasonable price. So looking at technology, looking at consumer discretionary. I think the places that also look interesting in the equity market is small cap. I mean, if Trump is able to really execute, and I think the places that he can really execute immediately with regards to deregulation, with regards to reducing some of the tax code, that really helps small cap companies.
You mentioned financials, though, because I just have to back up to that. Well, financials, Morgan Stanley, I mean, Goldman Sachs, they've been just on a tear.
Right.
I mean, can that continue? I mean, isn't it time to sort of say, okay, I made some money in financials, let me...
Well, I mean, let's look at the environment for financials leading up to this, right? We're in a situation where financials They went through the credit crisis. They came in with the regulators. They put a lot of regulation on top of the banks. We have very low interest rate environment, and we have a flat yield curve. So in those situations, those are all three things that really affect financials in a negative way. We're now in a situation where economy's growing, companies are doing better, the yield curve is moving up. All of these things help financials. So in our view, financials still have some room to run going forward.
And as far as bonds, what's your outlook in terms of the credit markets? Should long-term investors still be allocating money to bonds?
We think bonds are a critical component to asset allocation, but I think if you look at the bond market right now, we saw about $1.5 trillion go into bond funds and bond ETFs since the credit crisis. And if you look at what those bond funds are benchmarked to, it's the Barclays Aggregate Bond Index. You've got a 2.5% yield, you got an 8-year average maturity, and a duration of 7. And what that means to the investor is if rates start to normalize, if you see rates go up 100, 200 basis points, these bond investors are going to see their bond portfolios go down 7-15% in a pretty quick time frame. So we're not really excited about what's going on in the bond market, specifically around interest rate sensitive securities. The places that we do like in the bond market, preferreds, where you're getting a little bit of a yield pickup, and a lot of these preferreds are financial companies, which we think should do well, as well as convertible securities, where you have a bond, but you're also being able to participate in the equity market.
Excellent insight, as always, Chris. Thanks for joining us.